Good afternoon. Thank you for joining us for Spear's HY22 pre-close presentation. During today's presentation, I'll be providing shareholders with an update on our ongoing strategic achievements, portfolio health, sectoral performance, and how we see the year developing as we continue to operate in severely tough trading environments. Our assets and property management abilities have been put to the test over the last 18 months, and we are very pleased with the outcomes, the new strategies, and new ways of thinking implemented to continue our successful navigation of FY22. We wish to reaffirm our support to the national, provincial governments, our tenants and their respective businesses, as it is this collective that will propel us forward in these challenging times. If you have any questions during the presentation, please email them through to info@spearprop.co.za and we'll be sure to answer them straight after the presentation. I would furthermore like to take this opportunity to extend my sincere gratitude and appreciation to the Spear and Multiroom's teams for making meaningful inroads into our various strategic achievements over the last 6 months. So having a look at what I'm going to cover in the presentation today. So moving on to our environmental update. Over the last 18 months, South Africa has been firmly caught in the grip of the COVID-19 pandemic, fluctuating between various alert levels, restrictions, and infection waves. As a team and as a business, we knew that FY22 would be a challenging year, that would require our hands-on and active asset management levels to be taken up a notch to ensure forecast-aligned renewals and tenant retention targets were achieved. The operating environment over the last 6 months has been frustratingly unpredictable, with the onset of the third wave and stricter lockdown measures taking effect. International travel into South Africa remains at historically low levels, given the quarantine requirements placed on tourism when tourists requiring to return to their countries of origin, as well as South Africa remaining on the red list. The clumsy vaccination rollout has impacted not only the tourism, services and hospitality sector, but also the speed at which a meaningful return to work program can be initiated and gain meaningful momentum for corporate South Africa. The real estate sector, amongst many other sectors, remains negatively impacted by the events of the last 18 months, and also in particular the unrest and looting that took place mid-July in Gauteng and KZN. We are incredibly grateful to have been unaffected by the unrest, but deeply saddened by the impacts these events have had on our country, our industry colleagues, and their tenants. We'd like to wish them all well and trust for a speedy restoration and recovery. Notably, the half year has seen a decline in tenant support measures provided by Spear to our tenants despite the onset of the third wave and its relative restrictions. The lack of demand for office space has been worse than expected for the period, resulting in certain income assumptions having to be adjusted and recalibrated, but this mostly relates to the speed at which we plan to let up vacant space. But we are now starting to see meaningful and active office inquiries coming to the fore. The industrial and convenience retail portfolio has been resilient during the period and has contributed meaningfully to the half year. The conversion of the 15 and Orange fixed income lease has been completed, as well as the refurbishment, and will have an ongoing restorative effect on earnings for the year going forward. The vaccination rollout is now firmly underway, with in excess of 12 million South Africans having been vaccinated, and we hope that this will just further drive down the rising third wave, infection wave, and push it towards a decline. The need for South Africa to move to an amber country classification is vital, as international inbound travel, tour groups, conferencing, meetings and incentive travel will be able to restart. In the interim, we've been proactive, we haven't rested on our laurels. We've put together local market packages that are being actively sold and promoted to generate revenue. Spear's regional focus allows us to do intensive asset management on our portfolio and to meaningfully engage in the areas of the portfolio that keep us awake at night. I'm extremely proud of how Spear has maintained not only a 94% occupancy rate during the half year, but also has achieved a 94% conversion rate under letting activity from leases that were either expiring or needed to be renewed as at 27 August 2021. So moving on to our mission statement and strategy. Spear remains an authentic dividend-paying income fund, focused on consistently operating with a strong balance sheet and delivering on our mission statement, which is to be the leading Western Cape-focused REIT, to consistently grow our distribution per share ahead of inflation, and to operate within the top quartile of our peer group. Spear's strong real estate fundamentals, high-quality assets in sought-after locations, strong tenant covenants, and immersive asset management approach delivers consistently on our mission statement and strategic objectives. The strategic highlights I want to share with you today are as follows. We have continuously and successfully navigated the COVID-19 operating environment. As a business, we've optimized liquidity management over the period. We've maintained income statement consistency and strong rental collections year to date. There's been a commencement of notable industrial logistics leases across the portfolio with companies such as Grindrod, Nampak, and Mambo's Plastics, equating to 57,500 square meters, which when looking at the total portfolio makes up about 12.2% of total portfolio GLA. Our occupancy rates, as mentioned, have been solid at 94%. Our debtors book is under control and showing limited creep as older debt is serviced together with current rentals. Our earmarked disposal of assets is in progress, as disclosed on SENS, with circa 160 million of disposals currently underway, which should have a 1% LTV reduction impact on transfer. We've also successfully implemented our PV solar strategy, which has resulted in portfolio accretion as roof lease income has commenced, as well as a decline in overhead costs, given the fact that we get between a 30 to 40% penetration rate on our solar PV systems, whilst recovering 100% of consumption on site. Having a look at the strategic focus into the medium and long term, you will see as a strategy the continuing narrowing of asset ownership to commercial, convenience retail, and high-quality industrial assets with a clear focus on fixed income as opposed to variable income investments. We will maintain a distribution payout ratio of between 80 and 95%. We will prudently recycle capital through earmarked disposals and maintain a sound capital allocation tree. We will reduce and maintain our gearing ratio in line with our strategy of between 38 to 43% loan to value. We will maintain a conservative debt hedge profile of between 63% and 75% hedged at any given time for up to 36 months, as and when the opportunity presents itself. We'll maintain high portfolio occupancy percentages, and we'll be looking to unlock additional renewable opportunities and water augmentation measures in line with our ESG strategy across the portfolio and growth assets. Looking beyond COVID-19, Spear is in a far better place today versus this time last year. By this I mean last year, Spear and most of the world were in a fog of uncertainty about this pandemic, how it would play out, when the vaccines would arrive, where efficacy rates would be, when economic activity would kick back in, etc., etc. With the benefit of hindsight, we're able to plan better, make challenging assumptions about the future, and maintain tried and tested wartime environment strategies in the half year. Our half year 2022 operating scenario has been as follows. As trading conditions remain challenging, I wish to highlight 4 key areas of intensive asset management focus during the half year and beyond. Commercial, demand for office space remains subdued. We have to think outside of the box to position our office offering as attractive as possible with flexible lease terms, dynamic rates, and attractive installation offerings. The hospitality portfolio, with international travel being mooted, long stays, local market accommodation, and conference packages are actively marketed to generate revenue. Management remains committed to its hospitality exit, and inroads are being made to have no variable income exposure by the end of FY22. Vacancy creep. COVID-19 and work from home has had a material impact on the office market, with vacancy creep setting in across the sector. Spear has not been immune to this vacancy creep. Our leasing team has aggressive marketing strategies in place as return to work plans start to take shape and the vaccine rollout starts to expand. We can note even today certain green shoots that are emerging in this regard. Negative rental reversions. Defending income at lease expiry is becoming tougher and tougher. I'm satisfied with the letting activity stats that I will share further on in the presentation. Spear has performed better than most of its peers during the period, with single-digit negative rental reversions. Now, despite the challenges that the above 4 points present, I'm still comfortable and confident that our guidance provided to the market is sound and achievable. Furthermore, rental collections have been mostly in line with management's forecast. Balance sheet and income statement has remained robust and meeting all covenants. Our tenant cash flow assistance, as mentioned earlier, has reduced significantly. Liquidity availability has remained sufficient, which has allowed us to cover all operating expenses and interest over the period. There's no going concern risks, and we still have 150 million rand plus in cash availability and increasing. Our funders, being Nedbank CIB and Standard Bank Real Estate Finance, remain aligned and supportive of our strategies. Spear remains sufficiently capitalized to meet all its short and long-term commitments. Solvency and liquidity measurements have been passed successfully. Spear's renewal and relet program has been consistent. And notably, Spear is on track to achieve a 6 to 8% distribution per share growth guidance for HY 2022. So moving on to our salient details. So having a look at the portfolio snapshot, Spear owns 32 high-quality Western Cape assets with a portfolio value of 4.5 billion. Asset value growth compared to FY21 has been 1.09%. Our average property value is 139 million per property. Our average property value per square meter is 9,491 rand a square meter. Our average in-force escalation is 6.45%. Our portfolio GLA as at August 2021 is 470,881 square meters, which on a GLA basis comprised 55% industrial, 28% commercial, 10% retail, and 6% hospitality. Portfolio occupancy rate during the period is 93.47%. I believe this is due to Spear's tenant-centric approach, coupled with our early engagement strategy and in line with our historically high occupancy percentages. Our weighted average lease expiry profile is 28 months. Now, management makes a concerted effort to push out the well as far as possible. However, under the current trading environment, tenants have a reluctance to commit for the long term, as the operating environment remains uncertain, and this is mostly evident in the office portfolio. We are, however, also seeing longer-term commitments ranging from 5 to 10 years across sectors. Our focus remains on rent and tenant preservation in the short, medium, and long term. Thus, flexibility must be given in certain instances. Management's internal target of a weighted average lease expiry is 36 to 45 months. Our average portfolio rental per square meter is 95.81 per square meter on a gross basis. Our year-to-date collections to build is 95.06%, and we've maintained an intensive, focused approach to collections in the half year. Our year-to-date collections to budget set in January 2021 is 94.15%. The main variance between the two is basically that given the occupancy rates from people working from home, is the utility charges have been lower than what we forecasted, but they would have a benefit on both the income and the expense side. Having a look at our financial metrics, as mentioned, we're on track to achieve our distribution per share guidance of 6 to 8% growth for the half year compared to half year 2021. Spear will maintain an 80 to 95% payout ratio in line with our cash retention strategy and optimized taxation outcomes. Spear's SA REIT cost to income ratio for the interim period has been 43.01%, which is higher than normal due to it being reported on a gross basis per the SA REIT BPR. Furthermore, as a result of limited hospitality income for the half year, ongoing increased costs to adapt to the COVID-19 operating environment, which included limited tenant relief due to the third wave, bad debt provisions being increased, write-offs, and various health and safety costs. Spear's SA REIT administration cost to income ratio was 7.21%. Maintaining a low overhead cost structure is key, and the focus is to reduce this to between 6% and 6.5%. Our tangible net asset value has increased to 11.86 rand, which is a 3.13% increase, up from 11.50 rand in the prior year. The increase was a result of recognizing treasury shares as a balance sheet asset, which we had not done in FY21. Loan to value is 46.26%, post any fair value adjustments having been made. Our fixed debt ratio is 56.68%. This is below our desired levels, and post interims, the FTR will increase to 60%. Our house view is that interest rates are currently benign, and we are taking advantage of the low interest rate environment. Our CFO constantly monitors the FRAs and other metrics to ensure that he strikes and hedges out our portfolio debt over the next 6 to 9 months. Our average debt expiry is 28 months with no refinancing risk, with more than 280 million rand of debt renewed and extended during the period. Our average cost of debt is 7.08%. Our average cost of variable debt is 5.64%, makes up 45.32% of total group debt, and our average cost of debt, fixed debt, is 8.46%. Moving on to our collections. Our year-to-date collections have been largely in line with our forecast. Encouragingly, as I mentioned earlier, we're also seeing all the debt being serviced with current rental obligations. All our billings reflect after all credits and deferments have been passed. Income budgets were set in January 2021 using some of our best assumptions for the year ahead. Some of those assumptions have proven true, and some have had to be adjusted in light of the third wave. For instance, gyms, some restaurants and certain parts of the hospitality portfolio needed further relief. Tenant arrears for the interim period amounted to 13.4 million rand and decreasing consistently. There was a slowing down of collections at the onset of the third wave and the associated lockdowns in July, but I'm pleased to report that by and large the payment momentum is back to acceptable levels. Having a look at the slide for FY21 in terms of our revenue. So the budget was for the half year 274.1 million rand of budgeted rentals. We billed 271.5 million. We collected 258.1 million, which is a collections to build of 95.06% and a collections to budget of 94.15%. Just to break it down per sector, we collected 96% of our retail rentals, 95% of our commercial rentals, 94% of our industrial rentals, and 97% of our hospitality rentals. The 3% on hospitality that was not collected relates to relief measures provided to non-hotel tenants that are situated on the hotel property. Moving on to our letting activity. The table below reflects the letting activity for the period. Expiries and vacates during the period was 84,797. If you exclude hospitality, it was 68,618. We're looking at the reversion schedule. We achieved a positive reversion of 24.52%. The anomaly here is the new lease on 15 Orange that has commenced. Once taking that out, we would have on a commercial, retail and industrial basis a negative rental reversion of 5.79%, which compared to some of our peers, we are very pleased that this was managed under the double-digit amounts. Looking at Spear's expiry profile, as mentioned, it is defensive at 28 months. Our early tenant engagement contributed and mitigated deep negative tenant reversions, specifically in the commercial portfolio. The consensus view is that our portfolio rentals are largely either on market or below, and our assets remain in very attractive locations. The industrial reversion, which was in our forecast, was due to a shorter-term industrial lease of tenant vacating and us replacing them with a new long-term lease of 11,000 square meters. And our retail letting activity was largely in line with our forecast and remains resilient. So having a look at our balance sheet and funding updates, our covenants. Our proactive management approach with our funders, as previously stated, has given Spear enhanced optionality, headroom and flexibility to operate through the post-pandemic period without any potential covenant risks or distractions. Management, as mentioned in previous presentations, has reached agreement with our funders to relax Spear's strictest bank covenants for the FY21 and FY22 measurement period. Strictest LTV currently is at 55%, versus Spear's current LTV of 46.26%. Our ICR is 1.75 times in terms of the covenant, with a current ICR of 2.15 times and improving. noting that once the full effects of the 15 Orange lease come into the income statement, that ICR will improve even further. We are very proud that we maintain these excellent relationships with our funders, and both parties are aligned with our operating strategy going forward. As mentioned, we have zero going concern risks. We have sufficient liquidity available to us in terms of our cash holdings, and the only reason why that cash holding has reduced from reporting period to reporting period was that we had fully cash funded the 2,000 square meter extension for Nampak on their 14,500 square meter facility. We furthermore refinanced 280 million of debt during the half year. Our CFO, Christian Barnard, it must be commended. He's made meaningful inroads during the interim period to reduce Spear's average cost of debt. We are 6 months into a new financial year, and as you can see from the slides on your right-hand side, that the overall profile has continued to improve together with Spear's credit rating with our various funders. So moving on to our sectoral performance. Spear's portfolio has been resilient for the most part, as displayed in the level of collection set out earlier. Dissecting the sectoral performance for the half year provides deeper context to the trading environment and where management must prioritise asset management initiatives for the balance of the year. We'll start with our retail portfolio. Spear's retail portfolio is made up of 48,695 square meters of GLA. This equates to 10% of total portfolio GLA, and even more defensively, 41% of our convenience retail GLA is let to national tenants. All of our retail assets are classified as convenience retail. This is a subsector which, in our opinion, has been the most resilient. None of our retail assets are reliant on any local or international tourist markets. Our retail portfolio occupancies have been at 93.37%. Our collections have been at 95.79% versus revenue billed for the period. Spears provided credits and deferments to retail tenants to the following values: 950,000 Rand in credits and 485,000 Rand in deferments. The third wave lockdown had a lesser impact on our retail tenants than we anticipated. Our letting activity continues to be in line with our expectation, with the bulk of renewals being concluded per management's budget for the period. There's been no significant retail tenant failures occurring during the interim period, and there's been very encouraging tenant feedback received on trading conditions. We still hold by the opinion that open-air centres would trade better than closed centres, and notably our retail assets are all easy-to-access convenience retail assets. What are the risks? One of the lower levels risks is on rentals. 100% of our tenants are trading and paying their rentals. However, the pressure still on the gym tenants and some food-related retailers are taking longer to recover, which will require longer-term lease restructures as a result of the third wave impact. And probably the highest risk is further infection waves coupled with additional lockdowns and any possible unrest. Having a look at our commercial portfolio, 133,879 square meters of GLA, making up 28% of our portfolio. All of Spear's commercial assets are located in highly attractive and established office nodes in Cape Town. A lack of pre-pandemic tenant demand continues to impact the sector. Office portfolio occupancy is at 85.57%. Vacancy creep is due to non-renewals, as a lot of tenants are taking a wait-and-see approach, liquidations and business closures. Collections have been at 96.36% versus revenue billed for the period. Spears provided credits and deferments to office tenants to the following values: 123,000 Rand in credits and 32,000 Rand in deferments. Spears' portfolio is attractively positioned to offer expansion and or contraction space to third-party tenants due to its attractive lease terms and generally below market rentals. Expansion and contraction has been evident in the commercial portfolio as tenants adapt to social distancing and hybrid work regimes. As we move through the third wave and vaccine rollout momentum, a noticeable uptick in tenant inquiries for office space has been received. Currently, we have in excess of 3,500 square meters of new office deals under negotiation, ranging from Cape Town CBD, Century City, and Tiger Valley. Lease renewal negotiations have been extremely challenging as the return to work trajectory for business owners and our tenants remains uncertain. What are the risks? Asking rentals have softened as vacancies have risen higher than normal. Increased vacancy equals increased competition for tenants as every landlord wants to snap up the tenant first. The cost of installing tenants has also increased, and a prolonged return to work momentum has been evident as a result of a slower vaccine rollout than expected. Having a look at our industrial portfolio, which truly has been a moat around our business during these tough trading times, comprises of 260,229 square meters of GLA, making up 55% of our total portfolio. Spear's industrial portfolio has truly been resilient over the period, with several new lets and relets taking place in a very challenging market. The industrial portfolio occupancy has been at 96.85%. Collections have been at 94.38% versus revenue built for the period. Spear has provided no credits nor deferments to industrial tenants during the interim period. Strong demand for industrial rental properties persists in the Western Cape. Long-term leases, as I mentioned earlier, have been concluded over 11,000 square meters effective 1 August for Mambo's Plastics, a national retailer. A 10-year lease was concluded over 32,000 square meters for Grindrod Logistics Nova Marine, which commenced in April 2021. The warehouse expansion for Nampak as part of their new 10-year lease extension on 14,500 square meters has been concluded, of which the additional 2,000 square meters commenced in July 2021. This totaling, as mentioned earlier, 57,500 square meters, comprising of 22% of industrial GLA and 14% of total portfolio GLA. What are the risks? Is the reintroduction of load shedding, which will have a negative impact on our manufacturing tenants, labour relations, unrest and trade union disputes, increased capital requirements to maintain quality of industrial assets, and any major market or tenant failure. Moving on to the hospitality portfolio, comprising of 27,606 square meters of GLA, 6% of the total portfolio. We'll start with the DoubleTree by Hilton. The third wave impact has been severe. Pre-third wave, we saw a definite pickup in rooms and conferencing business as more and more people were comfortable with meeting and traveling within South Africa. The third wave has been a lot more stubborn in its decline than the first and the second waves. And management's focus has been firstly on the disposal of the hotel, and secondly on what alternative uses are there to management's disposal, either in the form of a residential conversion, co-living apartments, or medical facilities. There's been no meaningful international tourism to be expected for the FY22 year, as South Africa remains on the red list, hence my appeal to government and to the tourism department to lobby to move us onto the amber list. This will effectively kickstart some sort of recovery. We have initiated aggressive long stay campaigns to drive revenue to our DoubleTree Hotel. We haven't forecasted, as mentioned, any interim income on the DoubleTree for the half year. Moving on to 15 on Orange. As announced on SENS on the 18th of March 2021, management concluded a triple net fixed income lease over the property. The fixed income lease has significantly reduced Spear's exposure to variable income assets. The Capital Hotel and Apartment Group completed an 18 million rand refurbishment of all the rooms. The capital expenditure was self-funded by the Capital Group, and there currently is a 24-month fixed call option in place for the Capital Group to acquire the property from Spear within that 24-month period. Just delving into the business case on an earnings basis for 15 and Orange. In FY21, the property contributed 1.8 million in rental income, which was on a property level 0.87 cents to our distribution. In FY22, which notably will only be a contribution of 6.5 months, the property will contribute 10.4 million of income, which is 5.06 distributable income per share on property level, and a contribution of 4.19 cents distribution per share on a group level. In FY23, that will increase as a result of it being in the income statement for a full 12 months to 19.2 million, which on a property level will contribute 9.33 cents to the earnings, and on a group level will contribute 4.67 cents. Now, the lease has commenced on the 15th of August, hence me saying 6.5 months of income for FY22, and is at a starting rental of 1.6 million rand net rental per month fixed. What are the risks? That the business market recovers a lot slower. We have seen companies are now in the onset of the third wave and the stubbornness of the third wave, more and more reluctant to travel and have morphed back into more of an online positioning. The SA borders remain closed for international travel for longer, as SA is stuck on the red list, making inbound travel very difficult, as countries of origin have very strict quarantine requirements, and the meetings, incentive, conferencing and exhibition markets are reluctant to meet in larger groups. Just having a look at a general business update. General trading conditions do remain tough, with early signs of increased demand for Spear's rental properties, as I mentioned, towards the end of August. Our industrial and retail sectors are showing the most resilience. Our office sector vacancy creep has set in with a slowdown in rental demand. However, I wish to assure you that our leasing and asset management team have this as a top priority, given the fact that every bit of vacancy is a business profit that we give up. The 15 on Orange lease commenced on the 15th of August with Capital Hotel and Apartment Group, the benefits of which I've already discussed above. Our collections remain in line with management's forecast. Our balance sheet remains actively managed and robust. Our debtors book is well managed and on target with good recovery momentum on receivables. Our asset disposal and LTV reduction program is ongoing in line with our stated strategy, and our renewals program is in line with management's forecast. So looking ahead, amidst a very tough trading environment, the overall portfolio remains of high quality, well located, sectorally defensive, and underpinned by strong lease covenants. We have fielded increased commercial and industrial inquiries from non-Western Cape businesses since the civil unrest in July, and anticipate economic benefit to flow to Spear and the Western Cape in time as a result. Our hands-on asset management and focus will continue to result in meaningful letting activity across the portfolio. There's been a slow but notable economic activity resulting in increased inquiries for our rental properties. Increased momentum in the vaccine rollout with a high efficacy rate would create tailwinds for our economic recovery. And it's a high probability that the current collection percentage levels will be maintained and improved as we go on through the year. Spear remains well capitalized with sufficient liquidity and cash availability. There will be an acceleration of Spear's ESG strategy through PV, solar and socioeconomic impact investments. Our leasing and asset management team notes increased market activity across sectors, which is very encouraging. And there will be obviously an active engagement and ongoing success focus with our FY22 renewal and relet strategies. We believe that our regional focus and proximity to our assets remains an advantage. Our LTV range at period end will range between 45.5 and 46.5, and declining as disposals are finalised and LTV reduction strategy gains momentum. And in conclusion, our FY22 guidance is on track. This brings us to the end of this pre-close presentation. I wish to thank you for your attendance, and we'll be back shortly with you as myself and our CFO, Christian Barnard, join you for a Q&A session. Welcome back to our half-year 22 pre-close presentation. We're moving on now to the question and answer session. I'm pleased to be joined here by our CFO, Christian Barnard, who is extremely excited by the fact that Cristiano Ronaldo will be moving back to Manchester United. Are you not, Christian?
Extremely.
Kim, do you have any questions for us?
I do. I have a question from Highmast Investments for you, Quintin. It's a strategy question. You were quoted in the media this week about your long-term vision for Spear. What do you see the portfolio composition looking like on your journey to 15 billion?
Thanks, Kim. Yeah, maybe just as a start, we are less obsessed with the size in the journey and more obsessed with the quality of assets that we own. But in that, we've always historically had a strong bias towards industrial assets. So we would look to maintain that momentum going forward as we execute against the exit of our hospitality assets. And in that journey towards 15 billion, the portfolio composition would most likely look at like a 45% on a GLA basis allocation to industrial, 25% to convenience retail, which is a subsector that we like very much and believe that it's got a lot of long-term trajectory on it, 25% exposure to commercial offices with long-dated leases, and about 5% exposure to mixed-use assets, which will most likely come through an organic development approach we take on undeveloped bulk within the portfolio.
They also have a question for Christian. Well done on the improved costs of debt for the portfolio. Have your funders increased lending margins under the current refinance cycles?
Thank you, Kim. The margins have been relatively stable. What we have done is take advantage of the environment with low interest rates. So we've refinanced current fixed positions in our portfolio on lower all-in margins with longer-term debt, therefore bringing down the average all-in cost of debt. But relatively, the margins are stable, the banks are happy, and we're getting improved fixed-term debt on longer-term terms.
Thank you. There's another question for you, Christian, from Milka Investments. Can you comment on the payout ratio strategy and how you will arrive at the most optimal ratios?
That's a good question. What we do is we review the collections to build, as Quintin disclosed, currently at 95.06%, and then we determine in terms of what would the tax leakage be on any retained income. Then the tax leases we'll try and set off against any assessed tax losses we have in the group, as well as any tax credits, for example, for all the solar projects we've done, because you can deduct those solar projects of any tax payable. So we found the exact point where we can pay a full cash dividend to our shareholders, including pay any tax due to SARS without having to dip into cash reserves and reduce the further cash availability of the group.
Thank you. I've got two questions from White Road Investments for Quintin. Spear REIT's LTV has an approximate margin of safety of 10% relative to its LTV covenant of 55%. What strategic plans are afoot to reduce the LTV to below 40% in the next 18 months?
Thanks, Kim. So I think we've been very clear that that we wish to exit our hospitality investments. The main drivers behind our LTV reduction roadmap would be the disposal of the 15 Orange Hotel, the disposal of the DoubleTree by Hilton. In addition to what's been announced on SENS is the disposal of two properties to the value of 160 million rand. Collectively, they would most likely have about a 300 to 350 basis point reduction impact on our group LTV. Then just to talk to the margin of safety, we pretty much feel that the ratio where we are right now at about 46% is really the top end of the LTV scale that we would like to operate in. Being able to operate within a band of between 38 and 43% definitely gives us optionality. Unfortunately, we don't live in countries like Europe and the United States where they have extremely low interest rates, and we have to always ensure that we never exceed beyond a certain LTV level. And Lord willing, there's never a case where we have to embark on a north of 50% LTV. So quite happy to stay well below that 50% level.
Thank you. And their second question, once the LTV has been reduced to sub 40%, does management feel that there would be sufficient runway for concluding yield-enhancing deals, given that the LTV would be notably below that of the SAPOA average?
I think, just a general comment that, at the onset of the COVID pandemic, certain commentators were forecasting or prophesying doom and gloom with massive fire sales and assets being sold at huge discounts, which actually has not been the case. I think our first step is to achieve our strategic objective of the 38 to 43% LTV. And then, yes, we're in this business to grow not only its income, but also its balance sheet. So we will assess every opportunity as it comes. We do consider ourselves as value investors, and we'll be looking to acquire yield-enhancing assets, either through an acquisition, which will be a mixture of cash and debt, or through the very attractive Section 42 process, where we can do an asset for share swap, whereby the vendor would get the capital gains tax relief over a period of time, and they would also take a income position through the ownership of shares into Spear.
Thank you. A question from Primrose Investments for you, Quintin. Are you seeing any growth opportunities in the current trading environment? And how would you see these opportunities fitting into the Spear portfolio?
So, as I mentioned in the earlier question, growth opportunities have been few and far between. We haven't seen any deep value propositions coming to the market. What we are seeing is that valuations are actually holding quite firmly, especially in the Western Cape. I think there is a definitely stronger investment case to hold assets in the long term within the Western Cape, making sellers a lot more reluctant to negotiate on their pricing. But again, we adopt a less is more approach, so we don't have to own every asset in the Western Cape, but we want to own some of the best assets in the Western Cape. And also underlying within the portfolio, we are sitting on roughly 100,000 square meters of undeveloped but developable bulk, which we will also look to organically unlock in the portfolio, which hasn't been built into any portfolio valuations, which would enhance the portfolio NAV as those are unlocked. And some of them which are on vacant pieces of land we own as part of an acquisition we made a few years ago, which has no income drag, which would effectively be an organic uplift to the total portfolio through the development of those properties.
Thank you. Finally, I have a couple of questions from Selma Jackson. The first one is for you, Quintin. You have recently been quoted in the Business Day to divest out of the hospitality industry. Would you consider this to be a strategic decision, or is it due to the current impact of COVID-19?
I think it's very much a strategic decision. We would very much like to have continued to take advantage of the bumper tourist market within the Western Cape. But as many investors may or may not know, the hotel investment case is variable. So your income is really determined by your occupancy levels, which makes it very difficult to forecast and predict. Your capital allocation in terms of maintaining the asset is a lot more strenuous, given the fact that if I lease a warehouse to an industrial tenant, I've got to paint it inside and hand over the property. We're in a hotel, we have to consistently put money aside for fixtures, fittings and improvements. And our strategy, as we grow this business, is to have fixed income assets only, which exposes us less and less to the business operations of a tenant and more to the underlying quality of the asset.
Thank you. And further, she asks, what measures are currently in place to drive business to your hotel portfolio?
So the 15 on Orange team under the Capital Hotel and Apartments Group are doing an excellent job with the launch of the hotel and with various marketing initiatives. And on the DoubleTree by Hilton, we've launched an aggressive long stay marketing campaign. We have also launched a local market packages for couples. So if you are a couple looking for a sneaky getaway to Cape Town, or if you are looking for a bit of alone time, please have a look at our Facebook page or the DoubleTree by Hilton website for some deals. In addition to that, we have also heavily discounted our conferencing packages, which have all the required COVID-19 protocols in place in order to attract meetings and smaller conferences. And that being said, we've actually this morning had a look at some of our reports coming through from the DoubleTree team, and we started to see some very encouraging numbers coming through both on hotel occupancy, conferencing and food and beverage.
Thank you. And the last question, is you noted in your presentation that there are increased inquiries from non-Western Cape businesses since the civil unrest in Gauteng and KZN. Can you comment on what types of businesses these are?
Yeah, so obviously, our hearts go out to the people that have been affected by the unrest, and inquiries have ranged from office users looking to relocate their entire businesses to the Western Cape as they look at moving family lock, stock and barrel. So we've had those type of inquiries. We've had some manufacturers that have effectively lost all their manufacturing output in those regions that are looking to start afresh in Cape Town. And in addition to both longer term and short term storage, where goods that were already on the water were set for Durban Port had to be redirected to either Port Elizabeth or to Cape Town, where temporary storage had to be provided. And given the fact that we have limited industrial vacancies, we couldn't typically take full advantage of that situation with respect, but we are working with a few other opportunities that would create longer term tailwinds for the Western Cape economy, both from a residential, commercial and industrial perspective, as well as for Spear.
Thank you very much.
Thank you very much. It brings us to the end of the Q&A session. Again, we wish to thank you all for attending today, and also we recognize the fact that South Africa is under enormous pressure, both from a COVID-19 perspective, but also from an economic perspective. I'd like to encourage you all today to do your part, to build our nation, to believe that our future will be better than our past. And we assure you of our best endeavors at all times. And we thank you for attending today. God bless.